just say. So you buy it in your plan, you risk 750. You put in, you know what the global trend is, and gold is going higher. You think world inflation is going higher. You define your idea. Okay, I think it's going to be vigilance. I think we're going to see 50 basis points, and I'm going to see the dollar being sold off against the index of basket of currencies. You've done that, and then what you do is you would then also identify what I would call a fundamental changing event. In other words, what event is absolutely going to cancel your trade? Well, the obvious one there is the ECB don't mention the word vigilance, or gold doesn't go as high as you planned, so there won't be any rate hike, and the market is going to go. So what you want to do is when you get into a trade, list the main events that you think is going to affect your trade so that you're able to monitor it. The last thing the two last things I do is I look at the price entry strategy. As I said before, each currency has its own personality, okay? So as I said, the euro has a corrective personality, the British pound has a break personality, and for example, the dollar yen has a grind personality. That's a very slow kind of momentum-based currency. So basically, your price entries that you get involved in these currencies is very different than it would be, say, for the euro or for the pound or for dollar yen, okay? And then again, be it a stop or be it take profit, that you have a strategy getting out. In other words, what you're going to do, when are you going to take it, okay? I would encourage you to spend time to set up your watch list on the platform. And what you want to be able to do is you want to be able to turn this on in the morning or in the afternoon or in the evening. And you basically, it takes time, but what you want to be able to do is read these prices and read these markets, but really get to kind of feel them. Now, I know that sounds a little, but the thing is you need to be able to feel where markets are going. It does take a little bit of time, but if you start to learn where, say, the Aussie price is and where Brent is and where the DAX is and where dollar index is trading, and you see these prices, when you turn them on in the morning, you'll see, oh, look, gold has gone up from last night, dollar index has gone down from last night, oil is up a little bit from last night. And basically what will happen is that you'll be able to turn this on, and within 5 minutes, you can read down between the highs and lows and these prices, and you will then get a feel for what's happening in the world. In other words, you won't have to read the newspaper, you won't have to go into Bloomberg and look at the news or Reuters. You'll just be able to say there's been some event that has caused markets to move, and you will be able to find that event a lot quicker. So my recommendation is, and it does take time, but to follow the key ones to look at, in particular, would be the 10-year bond in the US. That's the key US interest rate for the long end. 3 month. This here is a short interest rate contract that tells you roughly where the Fed is going to be. This is the Australian dollar. This is highly correlated to gold, and it's an index for growth, the Australian dollar. So if the Aussie dollar is doing well, that means China is doing well. It means gold is going to go up, and it also means that global growth is quite good. If the Aussie goes down, it means global growth is going lower, China isn't doing as well, and there may be problems in Asia. So this is a great index for global growth. Oil is an index for global growth, but it's more correlated with sterling and Norwegian krona and the Canadian dollar. But bottom line is, again, you can see in an instance, if these two things are down, you know that risk is off. It gives you a heads up. If risk is up, that means the dollar is a little bit. The DAX is not a great contract for trading foreign exchange, but again, it's something to be cognizant of. Again, it's an index at risk. The dollar index, a really good contract. Again, it's kind of more weighted to the British pound, in particular the euro. But again, it's a low volatile version of the euro contract. And if you're starting off, or if you're trading FX, and you want to have a contract that has a little bit less volatility in it, as somebody mentioned already to me, I've been stopped so many times. This contract is perfect for you because it's got less volatility in it, so there's less chance you for your stake getting stopped. Then you have Euro Swiss, and again, the Euro Swiss is an index for the safe haven. At the moment, the Swiss is bid to the roof, and it keeps going higher. It's breaking records every day because of the debt crisis. The euro dollar, you'll know. Euribor, that's the key short-term interest rate for here in Europe. That basically tells you where the ECB is going to be, the pound, and then gold. So you can see on the S&P, and this is another very important one for the index, okay? So for risk. So just here, you can see within these contracts here, you can immediately see what's happening in the world. I won't run through these things here. the price behavior of currencies. This here is the euro, and it's what I define as a corrective currency. Now, what I mean by that is that, as a gentleman already said to me, I always get stopped. I always get stopped. And the reason why he's getting stopped is because there's so much volume and there's so much different types of market activities. In particular, central banks are involved now. Generally, if you have a break strategy, if you're trying to sell the euro or trying to buy the euros on breaks, you're most likely going to lose money. And the reason for that is very simple. It's just at this cycle in the market, what happens is, let's say this is the previous high to low range, be whatever time. Generally, the euro will do a break up from the low roughly 50%. It'll accelerate 50%, but then it will retrace from that new low to its new high, roughly 75%. So what it's doing is, if you're trying to sell here, you can see a bit of a move, but if you're looking for it to go further down, generally the euro will retrace. It's very, very corrective at the moment. And the reason for that is that you have on one side of the market, you have Asian central banks buying it, and on the other side you have hedge funds selling it, and vice versa. And there is so many players involved in the euro at such big amounts. Also as well, a lot of the volume is been short-term driven and stop-driven. So when all these false breaks are happening, it's very difficult. But bottom line is that it's what I would call a corrective currency. Now, there is opportunity and there is money to be made by being both long and short. But where you want to be involved is you want to be involved around here. You don't want to be involved around here or here in particular. You want to be involved around there. So back to my trading plan idea is that knowing that it's a corrective currency, let the move happen and get involved when it retraces. If you really believe that the euro is going to go down, just wait, let the break happen, and let that be an encouragement to you that you've picked the right direction and the momentum is going that way, but just be cognizant that selling it at the low, you most likely will get stopped. Wait for it to correct about 50 to 75% of its previous move, and you have a chance. Now, if you get stopped, fine, because your stop will probably be up here. But the bottom line is that it is the most economical way to be able to trade the euro. On the flip side, this here is the pound. This is what I define as a break currency. So here is the previous high-low range of whatever period you want. But basically, when it breaks, it goes greater than 50%. It goes of this, much more, 75%. So it goes a lot lower, so you can make money. In a break type of currencies, as I said the last time, I would encourage people to take profits. So if, for example, you're selling and you make 50 or 60 or 100 points in the pound, or a currency that's a break. So if you see something where it oscillates around here and then it breaks 100% of its previous range, but then it retraces back 75 or 80%, what you want to do is, if you see that money, take it. Don't go back to work without taking it. Because the chances are when you get home in the car, it'll be gone. And, so all I'd say to you is, if you can find, all it takes is a bit of work just to be able to, just with the calculator and just see like here, see this? You think it's going to, bam. Just a little bit of work. And it doesn't have to be 100% correct. It can rule of thumb, right? But the bottom line is just be cognizant of it. And I think the key thing that I'm really trying to say is that in these markets, if you see 50 points or 60 points, don't be a hero. Take it and start again. It's a good feeling making money. And the last thing you want to do is give it up. There's no point having an account if you're not going to use it. There is opportunity out there. There is money to be made, and you can do it. But you just have to be a little smarter about it. And the last one is what I call a grind currency. Now, these grind currencies can be brilliant because what can happen is if you catch a trend, they can keep grinding and grinding and grinding and grinding. Euro Swiss would be a very good example of this, or dollar yen. Basically what you have is you have the range, and then they only break maybe 25, 30%, and then they retrace 50%. But they move very slowly. But, as I said the last time, they break your heart, these kind of currency pairs. But the key thing is that when they break, by Jesus do they break. So, for example, if the dollar yen is trading 81, and it was a perfect example there in the last 2 weeks, 81s, people paid 81.20, 81.30. I traded yesterday, or last night, 78.37. But you have to wear that 81